problem is when you are no longer a W-2 employee and you're 1099ing yourself and you're not paying yourself, when it comes time to look at your tax returns and you might be writing everything off because you don't want to pay a ton of taxes, right? When you have a W-2 job, that's kind of taken care of for you. When it's 1099, you're a business owner, you have to figure that out. No one wants to pay a ton of taxes. And so they try to write off or claim as little as they have to. Totally understandable. The problem with that is when a bank is looking at that, they're going to see, okay, I see money coming in. You're proving that. That's great. But none of it's being claimed. So when you're not paying yourself, exactly like you said, you can still own your own business and W-2 yourself or however you want that to look. When you can show proof of income and not just that your business is making money, that is key right there. The business can make all the money at once, but when you aren't paying yourself and showing that you make that money, it's going to become an issue.
Welcome to Life After Corporate, your ultimate guide for making the leap from corporate leader to entrepreneur. I'm Deb Boulanger, entrepreneur, executive leader, and founder of the Launch Lab for Women Entrepreneurs. This is your time to break through the glass ceiling once and for all and get your ticket to the C-suite. Come back each week to get the leading strategies, advice, and tools that will give you the skills and confidence you need to replace your corporate paycheck. Are you ready? Let's go. Welcome to another episode of Life After Corporate, my friends. And if you're new to our show, welcome home. This is where you get everything you need in order to launch and grow a sustainable and scalable services-based business after leaving your corporate job. And today we're talking about how to fund your startup. I can't tell you how many women entrepreneurs underestimate how much they will need to invest before they start to replace that corporate paycheck. And my guest today is Frank Capra. He's an unsecured lending specialist with Preferred Lending Group. They are funding consultants for small business owners, and I'm excited to have you here. This conversation is way overdue, Frank. Welcome to Life After Corporate.
It is. Yeah. Thanks, Deb. Good morning. And I'm happy to be here. Let's have the conversation.
Yeah, let's do it. We're going to talk about all things money. So Frank is our funding partner for clients who want to secure some funding to launch and grow their businesses. And we're seeing some pitfalls where it's hard to get approved for some of the money you want. And so Frank and I wanted to have a conversation with you about how to think about funding the launch of your business and being successful right out of the gate. So Frank, I know you talk to a lot of people every single day. Would love for you to share your perspective on what our listeners need to be thinking about before they even leave their corporate job and launch a business.
Yeah, I think that's a great place to start. We are seeing a lot this year that there is a trend in entrepreneurs who want to leave their W-2 corporate job, whatever it is, and start their own thing, which is great. But there are things that we are seeing that aren't being considered, advised when leaving that W-2 job and taking the step into starting your own business and becoming an entrepreneur. So to start off that conversation and get the ball rolling, a lot of the time what we see, the first issue right off the bat would be leaving your job because you might have a nest egg and you have the savings and you quit your job and then go on the road to, okay, what do I want to do and how do I figure that out? The problem with that is whenever it comes time to, okay, I have actually found it, whether it be a franchise, a small business opportunity, whatever it is, when you can no longer show that W-2 income coming in, even if you have a nest egg and the savings ready to maybe put money down, whatever it is, the banks are going to automatically be concerned. There's a huge red flag when you no longer can show any income. So that is something that we're trying to get ahead of and show people, secure everything you need to secure. Keep that W-2 job. And, because it's a W-2 job, you're probably working 9 to 5 from 6 to 10, which isn't ideal, but this is what you should probably do is focus all your time on what do you want to do? How do you need to do it? What type of funding do I need? And secure all of that. That way you can show the banks, I have a current W-2 job of whatever that X is. You have that proof of income and it would be so much easier to secure everything you need funding wise. And then once it's secured, leave that W-2 job and get the ball rolling with whatever you're looking to do.
Such great advice. And so, before you make that emotional decision that,
Right.
today's my last day or next week's my last week, make sure you think about the funding that you need in order to successfully launch this business. And let's talk about other mistakes. So number one is show proof of income, because if you can't show proof of income, it's a red flag for the bank. You're not going to get funded. What are some of the other mistakes people make either when they first get started or maybe even 2 or 3 years in, and then they want to get some funding to grow?
Yeah, great question. So what we see a lot is maybe you did quit that job and you're getting, you're down that path already to entrepreneurship. A lot of clients of ours, we see that they're putting all of that debt on them personally, whether it be credit card debt, secured loans, small loans through their banks. They're taking all that on them personally, racking it up. And then when it comes time to, okay, we've done everything we need. We've done the market research, we've got product, whatever it is. When we look at them, it looks like they're totally over leveraged because they're putting all that debt on them personally before they have everything in line. And unfortunately, when we look at those clients, even though they can justify the spend and the cost and, oh, no, that's all for the business I'm starting, it's tough to get them additional funding for the business when they look so over leveraged. So we're trying to eliminate that. When you start a company or a business, LLC, whatever it is, you're always going to have an EIN. And my best advice would be put as much debt as you can on the business right away. It leaves you open to take on more debt when the business can't take it, especially those entrepreneurs who, let's say they have been in business for 2 years, 1, 2, 3 years, whatever it is. When they get started, they will be able to get some sort of debt through the business, but the bank won't want to put a large sum on them just because they don't have the years of a profit and loss. They just can't show it. So even though they can put all the credit on the business, when it comes time to, okay, we need a lump sum of cash to get the ball rolling, to take us to that next step, a lot of the time when it's on them personally, they won't be able to get that because when the business is so new, the bank is going to want them to be a personal guarantor on everything. The business won't be able to take that. Whether it be an SBA loan, everyone thinks that that's the best way to go is an SBA. You won't qualify right off the bat because of how new the business is and how over leveraged you personally already look. There's nowhere for that debt to go. So that's one thing that I think we're seeing quite a bit this year, unfortunately. Also, with where the economy is at, banks are not lending like they were in the past. It's not happening. So you have to look really strong and you have to show the least amount of exposure you can to get the amount of money that you need. Banks are tough this year, really tough.
So banks are really tough. So what does that mean? We have an EIN, but you've secured personal debt. And now suppose you're 2 years in and you're showing good profits, right?
Mm-hmm.
And you're on the payroll, which is another thing I want to flag here. If you're not on your own payroll, you are doing yourself a huge disservice. Whether you're an S Corp or an LLC, sole proprietorship is a little bit different, but you need to be on your own payroll so that you can show proof of income. But even if you have personal debt, and even if you have a business that's highly profitable, your personal debt will get in the way of you securing a loan for the business.
That's a great point. What we're seeing is, the profitability 2 years down the road. That's great. We see bank statements that show that all the time. The problem is when you are no longer a W-2 employee and you're 1099ing yourself and you're not paying yourself, when it comes time to look at your tax returns and you might be writing everything off because you don't want to pay a ton of taxes, right? When you have a W-2 job, that's kind of taken care of for you. When it's 1099, you're a business owner, you have to figure that out. No one wants to pay a ton of taxes. And so they try to write off or, claim as little as they have to. Totally understandable. The problem with that is when a bank is looking at that, they're going to see, okay, I see money coming in. You're proving that. That's great. But none of it's being claimed. So when you're not paying yourself, exactly like you said, you can still own your own business and W-2 yourself or however you want that to look. When you can show proof of income and not just that your business is making money, that is key right there. The business can make all the money at once, but when you aren't paying yourself and showing that you make that money, it's going to become an issue.
So let's dive into this a little bit further. So let's say I'm a business owner. Let's say I've been fairly successful. Maybe I'm bringing in, let's just say 300,000 in my second year. I'm paying myself as a W-2 employee $100,000 a year. I have $150,000 in profits. Do I qualify for a loan?
Yes. Well, I would assume so on the level that you just said. If you are showing a profit of $300,000 through the company, something I do want to mention before we keep going down this road is it's very important that when you own a business that you are claiming a positive spread on both the business and yourself. It's great if you pay yourself W-2, but if you then write off a loss on your business, that W-2 is no longer usable income. You cannot own a company that is taking a loss and expect a bank to give you any type of loan. They want to see a positive spread on both you and the company that you own. So it is kind of a double-edged sword here where, you don't want to pay double tax. I totally understand that. But when you are setting yourself up for working capital that you may need, you have to show a positive spread. That is very, very...
What is a positive spread? Define that for our listeners.
Say you own a business, and a lot of people like to put their business as their name or whatever it's going to be. That's great. You have to show that the company is making money on paper, and you have to show that you are getting paid money as well. You cannot say, well, I pay myself money out of this company that is taking a loss on paper. It's great that you're paying yourself, but when the company doesn't look like it's making money on their tax returns, the bank is going to say, well, yeah, you're paying yourself money, but the company isn't making it.
Yeah.
I know a lot of the time that's not true and that the company's doing just fine. But when it looks that way on your tax returns and bank statements, there's not much room for you to take any debt, unfortunately.
Yeah. And the takeaway here is if you're not paying yourself a fair market wage, because also what would happen to you? Like if you got hit by a bus, who would take over your role as CEO and who would take over the payment of that debt and running the company? So right. You need to pay yourself a fair market wage. So whatever it would cost to replace yourself with someone else is what you should be taking in an annual salary. So absolutely. And I know loans aren't the only way to go. You've mentioned to me, you have a variety of ways to get people money. What are some of the other ways people can get the funding in order to scale?
Great question. So our bread and butter is term loans, but like you just mentioned, that is not the only thing that we offer. We can do business lines of credit. Those every company used to have a business line of credit. Unfortunately, with the economy and where we're at, those are a little harder to qualify for. So we have become creative. We've kind of, I guess, evolved with where the market is. And we offer business credit cards as well. What's great about that is you are a personal guarantor on those cards, but every dollar you spend reports under the business. It doesn't report under you personally. So, and it's revolving just like a line of credit would. So it is a credit card in a traditional sense, but you're no longer putting all of that debt on you personally. It all reports under the business, which is fine for a business to see that kind of debt. When you put that debt under personal credit cards and you're getting started and putting that all on you personally, a bank isn't going to want to even hear a justification for what that debt is. They're going to see that. It's going to make you look over leveraged and it's going to really affect your lending ability. So we've kind of evolved with that and been able to give entrepreneurs another option there, especially when they're, year one, year two, or pre-revenue. That is a great way to have money that is available to you that will then report under the business. And then the business lines of credit, you have to be around a little bit longer, but that's in a traditional sense where you have that money available and, it's there for when you need it. And then the terms obviously are going to be monthly payments over a term.
Yeah. So monthly payments over a term for a loan, credit cards, 0% credit cards are readily available today. You can even bundle up a stack of them if you're looking to scale and get that extra income. Then you have a grace period, so you don't have to pay it back right away. That is also a viable option if you qualify. So let's talk about qualifications. What do people need to know and how do they need to prepare to qualify for either either debt option, whether it's a loan, a line of credit, or credit cards?
Sure. So we're going to go full circle here. So everything we just spoke about, those are things that you're going to want to consider when it comes time to either see me or an SBA banker, your bank, that you bank with personally. They're all going to look at the same thing. And what that is your debt to income ratio. Your credit scores are playing a huge part in this, especially this year. Like I mentioned, with banks aren't lending as easily as they have in the past. So they want to see that you are a strong credit, that you have a strong personal credit history, even if it's going on the business. Because the business is so new, you are responsible for everything. The bank's going to want to look at you personally. So right now, we really want to look in your credit scores. They have to be at least a 680, preferably 700s. You want to show at least a 5-year strong credit history, whether it just be, credit cards that you paid off on time. Everyone wants to see timely payments. They want to see that you're a responsible borrower. You also have to show, at least for term loans, you want to show at least $50,000 in adjusted gross income claimed. A lot of people don't understand that by not claiming any type of income, when you look at the full picture, it's going to make your debt to income ratio really high. And when it looks that high on paper, it's going to look like you're over leveraged already and cannot take additional debt. And that's going to become a problem. So we've kind of, after just doing this for as long as we have, figured that to get any type of money, you're going to want to show at least a 20 to 30% debt to income ratio. So you do have to figure out what that magic number is and try to claim that on you personally.
So explain how to calculate the debt to income ratio for those who don't know.
Sure. So I'm always happy to do that. But if you want to understand what that's going to look like, what you want to look at is your monthly bills, not utilities and so much like that, but how much do I have in credit card debt that I'm paying monthly? Do you have a mortgage? What is that monthly number? Do you have car payments? What does that look like? And you want to add all that up. Then you want to look at what you're claiming salary-wise, income-wise on you personally, and you want to divide that by 12. There's 12 months in a year. So what is your monthly allowance and what are your monthly bills? And then you want to take your bills and divide that by your monthly allowance, which is your income. And you want to see what that number is. That's exactly what an institutional lender is going to look at, is what is that number and how much more can they take in debt and be able to responsibly pay off on paper. That, at the end of the day, is what a bank is going to look at to see how much they can approve you for.
And so on the debt to income ratio, you say 20 to 30%?
Yeah, because you want it to be a little lower, just because once the bank approves you for whatever that loan amount is, they want to make sure that they're not over leveraging you after the fact. So you want that number to be a little on the lower side, because a term loan for any significant amount of money, you want to know that that monthly payment isn't going to be, $50 a month. It's going to cost money. And a bank wants to make sure that you can pay that back monthly. So they want to look at that debt to income ratio and say, well, if we give him this amount, it's going to cost this amount monthly, whatever that is. And, they have enough money to pay that back to us. They're going to be concerned about that. Ever since the pandemic hit and businesses just shut their doors, that woke a lot of lenders up, and they aren't as willing to take that risk as they were in the past.
Yeah. So if we were to summarize how to get your financial house in order to get the lending that you need in order to grow and scale, you want to pay attention to your credit rating, 680 or better in the 700s.
Absolutely.
Debt to income of no more than 20 to 30%. What about the credit card debt, the personal credit card debt?
Yeah, that's a great question. So your credit card utilization is going to play a part in this as well. You really want to show that no higher than 30%. If you're putting everything on your credit cards and making that number go through the roof, they're not going to give you more. It's just not going to happen. And so when you want to leverage yourself and put yourself in the best position possible, it's okay to have debt, but you want to make sure that that debt is in line with where your available credit is, where your debt to income ratio is. You want to make sure that that looks okay, especially when you're going to a lender. It doesn't matter how much your company is bringing in, how much you're making. That's great and all, but they want to look at, okay, well, how does that balance out where you currently are because you're obviously looking for more money. Why?
Right.
And they want to see if you are over leveraged, no matter what kind of money you're making, if you look over leveraged, they're going to be very hesitant to lend.
Yeah, absolutely. So get your financial house in order. This is great advice for how to prepare. Prepare early. Make sure that you have the funding. And everyone I know underestimates what it really takes to fund a startup, or how long it really takes to replace a significant corporate salary. If you're making $250,000 to $500,000 a year, it's going to take you 2, 3, 4 years in order to make that back.
Yeah, absolutely.
And then a lot of time you're going to want to reinvest that into the growth of the business anyway.
Right.
So that, and, credit cards are expensive debt. If you can get approved for a loan, what are some of the rates that you're seeing now for the lines of credit or the business loans?
That's a great question, because it's changing a lot. And I think that's what a lot of new entrepreneurs aren't understanding is, let's take this back to the pandemic or 2020, a few years ago. People were getting 0% interest on everything. And even your normal rates were 3 to 5%. Now that the world's kind of getting back into gear, and even this year, money's really expensive, you can expect rates anywhere between 8 to 15%. That's a sticker shock for a lot of people. And it's just where the market is. It's where our economy's at. And so you need to understand that when you want to take that leap of leaving your W-2 job and starting your own business, that money is expensive right now. I'm sure everyone kind of sees that. It's not just what we do. It's SBAs are expensive. Bank rates are expensive. Mortgages are through the roof right now. It's just where we're at. And so I don't think that is an answer to say, well, let me just hold off, because rates have kept going up. I don't expect them to go down anytime soon.
Mm-hmm.
But you have to understand where they're at so that you know what you need to do and what that cost of money is, so that you are not so shocked and hesitant to pull the trigger. It's just, kind of where our current economy is. And I don't see that changing anytime soon.
Right. But it might be smart to lock in even at, 8 to 15%, because the credit card rates are variable, and, they can go up to a cap of like 25% interest. So you can be spending a lot of money on your personal debt.
Mhm.
So yes, think wisely, prepare yourself before you have a conversation with Frank. And Frank, is there anything else, any final thoughts you want to share?
Yeah, give me a call. I'd be happy to discuss this further. I'd be happy to look at you personally and see where you're at, what's available to you. We don't hold credit here. There's no obligation when you pre-qualify with us. And a lot of the time, I think people are nervous about, it's so real if you start talking to me and get those numbers. But I always say, come to us, have the conversation, get pre-qualified, because then you know what's available to you. You have an idea. A lot of people think they know what they can get, and that's great, but why not talk to someone who can say, well, this is where you're at. This is what you can expect. This is what you can qualify for. And the fact that we don't pull credit here, it's really no harm, no foul, because we can look at everything, give you a pre-qualification, and say you kind of are not quite ready to jump, into this. You'll know where you're at. You'll know what's available. Things can always change. We've seen rates change weekly. So if you think you are ready, I would not be so hesitant to do so because of where the economy is at. But have the conversation at least.
Yeah. And then you can put in a plan. If you're a little over leveraged on the debt, put in a plan to pay down your debt so that you can qualify for a loan at the right time. And also, the last thing I want to share is a warning to listeners to beware of predatory lenders, that there are people
Yes.
who will give you unsecured debt at outrageously high interest rates, and it's bank robbery. Literally, like, don't fall prey to that. The vig is too large.
Yeah, that's a great point. We see that all the time, where there are still predatory lenders. It's unfortunate, but they're out there. There's a lot of them out there, and they make their rates sound really good. And then when they lock you in, the terms are terrible. They have access to your bank accounts. They can take out draws whenever they want. And the rates are absolutely insane because it's private money. They make the terms. They make the cost of money. So be very careful. I can't tell you how many entrepreneurs come to us and say, hey, I need a loan from you so I can reduce my interest rate and get rid of some of this private debt I have. Unfortunately, whenever we look at those clients, they're so over leveraged because of their payments that it's hard to get out of those once you're in them. So have the conversation. Don't jump into anything that might sound too good. We're happy to take a look and try to push you in the right direction and tell you what your options might be.
Fantastic, Frank. So in the show notes, we will post our partnership link to Preferred Lending Group, which will get you in touch with Frank, and your phone number. Just be sure that you heard about him on Life After Corporate. Frank, thank you so much. This was such a rich conversation that many people don't have, and I'm sure it's really served our audience today in helping them understand how to secure the right money in order to launch and grow their business. Thank you so much.
Yeah, absolutely. I was happy to have the conversation.
All right. That's it for now, my friends. We will see you next time on Life After Corporate. Have a good one. Thanks for listening, my friend. If you enjoyed this show, please head over to iTunes and subscribe and leave us a review. And be sure to hop over to the Life After Corporate Facebook group and join other growing entrepreneurs to get weekly tips on how to create more money and meaning doing work you love.